So let's begin with the big story. Many people convinced that better numbers won't change the Fed's next move.
The U.S. economy seems to be doing fine.
Very few in the market see upside risk to either growth or inflation.
Slowing, but not slowing, very rapidly.
Life is just a little less comfortable than it once was.
Which is why very likely we'll see the Fed modestly cut interest rates over the next several months.
The Fed wants to act.
You're looking at a very accommodative Fed. The Fed has caved to the wishes and mandates of the market.
The Fed is now clearly in insurance mode.
The Fed is cutting rates for insurance purposes.
By a little bit of insurance.
The insurance cuts.
Try to prolong the recovery.
It seems almost inconceivable that they won't deliver.
Some odd small chance, maybe 5%, they don't do anything.
The expectation that the Fed would be overly accommodative.
They're all in the easing camp, and the issue is by how much.
So the key question for us this morning, will anything stop the Fed from cutting interest rates on July 31st? Joining us around the table here in New York, Matt Hornbach of Morgan Stanley and Krishna Memani of Invesco. Krishna, your thoughts on that?
Well, I think he had an opportunity to walk the markets back, or at least to make it more contingent. He didn't. So expecting it to change from now till end of the month, I don't think is a decent expectation, even if the data ends up being strong.
What do you think, Matt?
Well, look, I think if we had had a weak retail sales number and a weak non-farm payroll number, it would have told Powell that he was already too late. So, we have to understand that this is what Powell wants to see. He wants to understand that what he has done year to date has been the right move, and the data is telling him that what he has done has been the right thing.
Matt, some people might sit here and say, you know what, it might not change whether the Fed goes in July at the end of this month. It might change by how much they move by, 25 basis points or 50. Your house view is a 50 basis point cut July 31st. Do the numbers between now and then change a thing for Morgan Stanley?
John, to be honest, not really. I think what might be more important than the data itself is the perspective from other central banks around the world. Remember, this is a global growth issue for the Fed, and if the ECB later this month comes out and says downside risks have increased, right? The data out of Europe was not good this morning. The ZOO survey out of Germany was a downside surprise. So if the ECB is coming out and telling the Fed that things are getting worse in Europe, the Fed is going to react to that.
Krishna?
I think I have a little difficulty with a 50 basis point cut in the midst of the sort of data that we are getting. I think they want to make a statement to the market, but at this point, given the strength in the data and expectation that things in the back half of the year are going to improve significantly from how things were in the second quarter, I think 25 basis point is the right response, and that's what they'll do.
The pushback that I know you get around the 50 basis point call is one of the most dovish officials on the FOMC. Jim Bullard has told us here at Bloomberg that he's basically ruled out a 50 basis point cut at the end of this month. So if he doesn't want one, who does want one? What's your response to that, Matt?
Yeah, well, the first thing I would remind your viewers, John, is that a year ago, James Bullard's dots were actually at 1 7/8. So, it's hard to know exactly where he thinks appropriate policy is because his dot plot is always so flat, John. But I'd say, it does matter what Jim Bullard thinks, but it matters more what the core of the committee thinks. And Powell had a perfect opportunity during his testimony to Congress to push back against the notion of a 50 basis point rate cut. And he did not take that opportunity, John, which suggests to us that the framework that the core of the committee is operating with is a risk management framework. And when you're operating with a risk management framework, doing just what's in the market price is not enough.